In the last video, we left off discussing child tax credits, and so let's take a look at an example of how to calculate a child tax credit. And the one I've chosen includes a phase-out because of the high AGI of the taxpayers. The one I'm looking at is number 35 on page 9-46, where Justin and Janet have AGI of $456,000. They have the one qualifying child under 17. How much of the tax credit can they take? Well, because they have the one child, the most they could take is $2,000. However, their AGI is quite high. It's $456,000. And for married filing joint, for every $1,000 over $400,000, you reduce this credit by $50. So in this case, they have $456,000. So we would deduct from $456,000, we would deduct the $400,000. So I have that in this formula. 456 minus $400,000. That'll give us the number of $1,000 increments that they exceed the threshold by. Well, in this case, it would be 56 $1,000 amounts. So since there are 56 $1,000 amounts, we multiply that 56 by $50. That's the reduction per thousand over the threshold. Well, when you multiply 56 times $50, you come up to $2,800. $2,800 reduction is greater than the credit itself. So in this case, the taxpayers are completely phased out of taking the $2,000 credit for the one child. Another credit they mention in the text in Chapter 9 is the contribution to retirement savings account. So they encourage especially low-income earners to contribute to these savings accounts, whether it be a 401k, a simple, a SEP, 403b, a 457. IRAs as well, both traditional and Roth. The maximum amount of contributions for the credit is $2,000, so that's the maximum contribution. And then you look at percentages to calculate the credit, as well as the filing status. So let's take a look then at an example of the retirement savings contributions credit before moving on to other credits. The one I'm looking at in this case is number 37, found on page 9-47, where Jerry and Ellen are married, filing jointly, have AGI of $45,000. They did make a contribution to a qualified retirement plan of $1,500. What is their savings retirement contribution credit? So I entered the data given, the $45,000, amount they contributed to their retirement, maximum amount that is qualified for the credit of contributions, which is $2,000. And this should be maximum amount of contributions. That qualify for the credit. And that is $2,000, and they're under that threshold. So what we need to do then is to look at the applicable percentage. And that's found on table 9-2 on page 918. So if you go to page 918, you'll see they have various categories of household income as well as the type of taxpayer. Looking on that table, then, we see that these taxpayers would be entitled, based on their filing status and their income, their AGI, of a 10% applicable percentage against their contributions. So they take 10% then of the $1,500, which is the lesser of $2,000 and $1,500, and that'll give them a retirement savings contribution of $150. The key, of course, actually two keys in this case, is to get the amount of the applicable percentage, and then be sure to remember that the contributions maximum per year would be $2,000. In this case, they fall well below that. So 10% of $1,500 is, as I said, $150. Moving on, there is also an adoption credit. This credit is available for 100% of the adoption expenses. This credit can generally be taken in the year the adoption becomes final, so any preceding year's expenses would be recognized for this credit purpose in the year the adoption becomes official or finalized. It does phase out, as other credits and deductions often do, based on the income. So if AGI reaches $243,450, it's completely phased out, and here's the formula, which I'll demonstrate shortly, for the adoption credit. So let's jump back then to and the one I'm looking at here is, let's look at one a little bit more complicated. Let's do number 40. So number 40 on page 9-47 is also in Connect, but I think we'll go through it anyway, and you can do it as well on your own to kind of check the calculations. So the adoption expenses were actually $14,675 for these taxpayers. That exceeds the $13,810. So part of their adoption expenses will not qualify. Modified adjusted gross income was $225,000. And the question is, how much credit are they entitled to? Well, in this case, and I'm just going to work inside the parentheses first, I'm going to take the maximum upper threshold limit of $247,140, which I just mentioned on the PowerPoint, and I'll deduct the $225,000 of income. And then I will multiply that by the qualifying expenses, which is $13,810, not $14,675. That's too high. So the upper limit is $13,810 for 2018. And then that is the amount of the credit, the reduced amount of the credit that's available for these tax credits, because they're partially phased out because of their income. Again, I strongly recommend that you go through the calculations yourself, verify that my amounts are correct, and then it's a good way of kind of reinforcing your understanding of the adoption credit. Another credit that they discuss in this chapter is the earned income credit. This is for economically disadvantaged taxpayers. It is fully refundable, so this is one of the few credits that is fully refundable. So in other words, even if the taxpayers had no tax liability, they could still file a tax return if they qualify and receive a refund for the entire tax credit. The earned income, wages, salaries, and tips is adjusted for 1/2 of the self-employment taxes. And if the taxpayer to qualify for this earned income credit must have a qualifying child. The credit can completely phase out at certain income levels, and investment income in excess of $3,500. In other words, this is an earned income credit. So if you have unearned income, such as investment income, if you have too much of it, then you'll be ineligible, or the taxpayer would be ineligible for this credit. So they talk about some of the earned income credit amounts. For one child is $34.61 in 2018, $57.16 for 2, and in 3 or more children, $64.31. If you have no children, you could qualify for $519 maximum earned income credit. So let's look at an example of the earned income credit. Well, here's a case where we have this, by the way, is number 42, bottom of page 947, where Thomas and Stephanie are married and have 4 qualifying children. Their AGI is $27,500. Calculate their earned income credit using the formula. There are 2 ways in which you can determine, and I have a little note here. There are 2 ways in which you can determine the earned income credit. One is to do the formulaic method, which we'll be demonstrating here shortly. The other way is to look at the tables at the end of Chapter 9 and just look it up, and you can find the credit that way as well. But let's walk through the calculation here. Again, this is problem number 42 on the bottom of page 947. So I just entered the couple's AGI of $27,500. Maximum earned income credit of $64.31. Phase out percentage, and again, these amounts are given to you. If you look at the table on page 924, it's table 9-3. Again, you look at the number of children and the filing status, and then these amounts are given to you in the table. They're not given in the problem, but they're given in the table on page 9-24. So I just filled in the applicable amounts, and you can go back in the table and verify that the amounts are correct based on the number of children and filing status and so forth. And then I calculated the amount the maximum earned income credit is reduced based on the income, and that was calculated by taking the $27,500 and reducing it by the $24,350 where the phase out starts. So $27,500 minus $24,350, and then that we multiply by the applicable percentage of 21.06%. So once again, $27,500 minus the low end of the phase out range of $24,350, and then you take the difference there and multiply it by 21.06%, and these taxpayers will have then a reduction of their earned income credit, which was maxed out at $64.31. They'll reduce that by $663, which is the calculation we just went through. And the difference between $6431 and $663 is $5,768. So that's the earned income credit for these taxpayers.